Welcome to my YouTube channel. In this tutorial, we'll be looking at property, plant, and equipment, part 3. The main emphasis in today's lecture will be about the deferred interest and also decommissioning costs. Let's dive into the question that we have before us. This is a simple question on IAS 16, property, plant, and equipment. Pagodo Limited incurred the following expenditure with respect to the purchase of an asset and to bring the assets to the location and condition for its intended use. The first cost here is site preparation costs, which is 130,000. Remember from the introductory lecture, we said that there are some costs that should be capitalized, and there are some costs that should be expensed through the profit and loss account at the initial recognition of an asset. So site preparation costs, cost of test running, including material, is 78 million. Installation costs as 200,000, 78,000, 200,000. Purchase price of the asset is 3 million, and professional fee is 150,000 naira. All of these costs are to be capitalized. But let's look at the additional information to know if there are any other adjustments that needed to be made to the cost highlighted above. The asset was delivered on 1st of February 2010. So this is the date of delivery, 1st February 2010. It took two months to install the assets. So just take note of this. The asset was delivered on the 1st of February 2010. It took another 2 months to install the assets. That means as at the date of delivery, you cannot start depreciating the assets because the asset has not gotten to the condition for its intended use. The asset was ready for its intended use on 1st of April 2010. It was supposed to use on 2nd of June 2010. So the moment the asset is at the location and it's ready for its intended use, depreciation begins immediately. So it doesn't matter when the asset was put to use, so long as it has been in that location and condition for its intended use, which is 1st of April 2010, depreciation commenced that same date. The item used for the test running were sold for 22,000 naira. So now let's go back here. The cost of test running is 78,000 naira, including material. That means there were some material that were bought for the test running of the assets to ensure that the asset is working properly. For part of those material, the company is able to recover 22,000 naira. So the net will be 78,000 naira less 22,000 naira. That is what will be capitalized as part of the costs of the assets. The payment for the asset was delivered. Sorry, the payment for the asset was deferred. The purchase price is 3 million. Deferred means that the assets was not paid for immediately, but the purchase price is 3 million and is expected to be paid in 3 years' time. The appropriate discount rate is 5%. Now, according to the guidelines of IAS 16, when there is a deferred payment, it is the cash equivalent of that amount that will be capitalized. So we are assuming here that there's an interest element on this 3 million, and the interest element is 5% per annum. So 3 million will not be capitalized. What will be capitalized will be the discounted figure, which we are discounting this 3 million by 5%. The asset is expected to last for 8 years. The asset is depreciated on a straight line basis, and depreciation is charged proportionately. Proportionately means that we are going to apportion the depreciation charge for the period. The future value of the commissioning cost is 250,000 naira. Remember from the initial lecture, we said the commissioning cost should also be capitalized. If you've not watched part 1 of this series, please go to my YouTube channel and watch the part 1. And the appropriate discount rate is 5%. The site will be restored back in 8 years' time. Required, let's look at the requirements. Calculate the cost of the assets at initial recognition. Also calculate the carrying amount of the assets as at December 2010. Initial cost of the assets. So let's look at what the initial cost of the assets will be. Basically, these are the costs that we are expected to capitalize. We'll just make a few adjustments. Now the purchase price of the asset is 3 million naira, but this will not be paid immediately. Paragraph 23 of IAS 16 states, the cost of an item of property, plants, and equipment is the cash price equivalent at the date of recognition. If payment is deferred beyond normal credit term, the difference between the cash price equivalent and the total payment is recognized as interest over the period of credit, unless such interest is capitalized in accordance with IAS 23 borrowing costs. So now I want you to look at the word deferred payments. So basically, the guideline of IAS 16 states that if there is interest elements in the purchase of an asset, the interest elements will be expensed in the profits or loss accounts. But IAS 23 provides a provision for capitalization of interest on qualifying assets. This will be treated in subsequent video, but in this video, interest elements will be expensed through the profits or loss accounts. Let's look at the purchase price. The fair value of the asset is 3 million naira. So we have 3 million as the purchase price of the assets. This 3 million will be paid in 3 years' time. The discount rate is 5%. So the assumption is that the seller of the assets is charging an interest equivalent to 5% on the assets. So we need to discount those 3 million to present value using the discount rates in that arrangement, which is 5%. So this is the future value, 3 million. The present value will be your normal discount rate 1 plus R. And your R here, remember your R here is your discount rate, so equal 1 plus R, which is 5%, raised to the power minus 3 times 3 million. This is the present value of 3 million naira. So we assume this is the cash equivalent. So if the company were to purchase these assets in the open market or purchase these assets for cash, the company would have paid 2,591,000. And that is what should be capitalized. The difference will be this minus this minus this. The difference is 408,487 naira. This difference will be expensed through the profit or loss account for that period of 3 years. So at initial recognition, debit the assets and credit liability with the present value of the expected payment of 3 million. So at the beginning, this is the opening balance and interest will be charged. So we are assuming here, the assumption is that if the company had borrowed this money to buy the assets, the company will be borrowing 2,591,503 naira to buy the assets. And at the end of year one, the company will be paying interest of 5% on that amount, which will be this times multiplied by your interest rate of 5% times this. So I will lock the cell with $2 sign, times this. So I'll lock the cell with $2 sign so that I can drag the formula. So the total liability at the end of the year will be initial liability plus the accrued interests so plus this amount. So at the end of year one, if the company had borrowed money to buy the assets, the company would have been owing 2.5 plus interest of this. The balance will have been this 2.721. Opening balance will be this. So we're assuming that the interest won't be paid annually. The interest will be paid at the end of year 3. So there will be an accrued interest of 129 or deferred interest equal. Okay, no need. Let me just drag my formula since I already have the formula here. Drag it down. Also, drag the second formula. So at the end of year 2, total interest will be 265 plus your initial liability of 2.5 will give you 2.8. At the beginning of year 3, your opening balance becomes your closing balance for the previous year. Interest is 5% on this amount, which is 5% here times this amount, and the closing balance also will be your opening balance plus the interest rate. So at the end of the period, the interest that will have been accrued for will be 408,489, which is this amount here, 408,489. Well, this is the way it will go. It will be expensed through the profit or loss account every year. You debit your profit or loss as an expense, and you accrued for the interest. At the end of the period, the accrued interest plus the initial liability will be 3 million naira. So what will be capitalized at initial recognition will be 2.591513. So back to our purchase price will not be 3 million, but rather to be 2.591513. We also need to make adjustment for decommissioning cost. This cost initially was, so the cost initially was 78 million. Let's go back to the question. The cost initially was 78 million. Test running cost here is 78 million, but out of the 78 million, we're told that items that were used for test running the assets, some of the items will be sold for 22 million. This 22 million, that means there's going to be an inflow, which we use to net off the initial 78 million to arrive at 56 million, which is 78 million minus 22 million. Final adjustment will be decommissioning costs. Decommissioning cost, how do we calculate decommissioning costs? The future value of the decommissioning cost is 250,000 naira. The appropriate discount rate is also 5% here. The site will be restored in 8 years' time. So present value, that's what we want to calculate. The future value is 250,000 naira. What will be the present value? The same way we calculated for the cost of the assets. So 1 plus the discount rates raised to the power minus 8 times 250. So this gives us 169,209.84. That will be the decommissioning costs. So what will be the total cost of the assets? Total cost of the assets at initial recognition will be 3,296,723 naira. The B part of the question, let's read the B part of the question. Calculate the carrying amount of the assets as at 31 December 2010, as at December 2010. So remember that the asset was purchased or delivered on 1st of January 2010, but as at this period, the asset is not ready for its intended use. So depreciation cannot start as at 1 February. Depreciation cannot start as at 1 February 2010. It also took 2 months to install the assets. The asset was ready for its intended use on 1 April 2010. It was put to use on 2nd June 2010. We have 3 dates here. The depreciation will not start on 1st February, but it will start on 1st of April, because as at 1st of April, the asset is at the location and condition required for its intended use. So from April to December is how many months? April, May, June, July, August, September, October, November, and December. That's 9 months. Depreciation, we said depreciation will charge proportionately. That means we are going to apportion depreciation for 9 months. Let's do the calculation. So this is the cost of the assets. Depreciation, annual depreciation will be this divided by 8. The asset is expected to last for 8 years. So annual depreciation will be that. Monthly depreciation will be the annual depreciation divided by 12. And depreciation for the year, this will be April to December. Equal monthly depreciation multiplied by 9 months. That's the depreciation for the year. So the carrying amount as at December 2010 will be the initial cost minus the depreciation for the period, which is 2.987654.89. This is the carrying amount of the assets as at 31 December. This is the cost of the assets at initial recognition. Thank you.